2026, millions of Americans will pay more tax without Congress raising tax rates. Hey everyone, welcome back to the channel. If you're new here, hit that subscribe button because what I'm about to share affects your wallet directly. Before we begin, I need to clarify something important. The face you see in these videos and the voice you hear, those are not unique anymore. Anyone can use them. You'll see them on many channels. But the original creator is me. I was inactive on YouTube for a while, and during that time, many channels appeared claiming originality. Example, many ags, guys, and blah blah. I'm back now. And from here on, this channel is the original source of these ideas and videos. Don't get confused by copies elsewhere. Let's continue. Most people think tax changes happen loudly. Congressional debates, news headlines, angry tweets. This one happens quietly. And by the time you notice it, it's already too late. And if you are in a regular salary, this affects you more than the rich. Here's what's wild. This isn't a conspiracy theory. This isn't a prediction. This is literally already written into law. But almost nobody is talking about it because it's not a new tax law. It's an old one quietly expiring. And here's the thing about expiring laws. They don't make headlines. There's no dramatic vote. No political theater. They just end. Think about it like this. When your phone's free trial ends, they don't send a news crew. They just start charging your credit card. That's what's happening here. Except instead of $10 a month, we're talking about thousands of dollars for the average American family. So let's talk about what's actually expiring. Back in 2017, there was this massive tax overhaul. Love it or hate it, it changed how most Americans file their taxes. Lower tax brackets, bigger standard deduction. Child tax credits doubled. A lot of people saw their taxes go down. But here's the catch, and this was buried in the fine print. Most of those changes had an expiration date, December 31st, 2025, which means on January 1st, 2026. Unless Congress does something, the tax code snaps back to the way it was before. And the biggest financial mistakes usually come from what people didn't see coming. 2026 isn't far away. And the hidden tax increase starts the moment the calendar flips. Now you might be thinking, okay, so taxes go back to what they were. That's not a huge deal, right? Wrong, because it's not just one thing changing. It's 4 different ways your taxes could go up, all happening at the same time. And they stack on top of each other. Think of it like this. Imagine your rent goes up, your grocery bill increases, your car insurance doubles, and your phone plan gets more expensive. All in the same month. That's what this feels like, except it's your tax bill. Let me break down these 4 hidden tax increases. And I promise once you see how they work together, you'll understand why this is such a big deal. First up, bracket creep. Now, this sounds technical, but stick with me because this is where it gets sneaky. Here's how it works. When those 2017 tax cuts expire, the tax brackets change. But not the way you think. Let's say you make $60,000 a year. Right now, you might be in the 12% tax bracket for most of your income. But in 2026, more of that same $60,000 gets pushed into the 15% bracket. You didn't get a raise. You didn't earn more money, but the IRS treats you like you did. It's like if your grocery store suddenly decided that the first $1.50 you spend is regular price, but everything after that is 25% more expensive. You're buying the same groceries, but your bill is higher. Now here's where it gets worse. Remember inflation? Over the last few years, prices have gone up for everything. Your salary might have gone up a little to keep pace, but the old tax brackets from before 2017, they don't account for all that inflation. So even if your salary only went up because eggs and gas cost more, the IRS doesn't care. You're in a higher bracket. Here's a real example. Let us say you got a 3% raise every year since 2017. Not because you're re-raking it in, but just to keep up with the cost of living. In 2017, you made $55,000. Now you make $65,000. In real life, you're not actually richer. You can buy about the same amount of stuff, but the tax code doesn't see it that way. It sees that extra $10,000 and says, cool, you can afford to pay more, except you can't. because bread costs twice as much. The poor get credits, the rich get strategies. The middle gets squeezed. Okay, part 2, deductions shrinking. This one hits homeowners and people with kids especially hard. Right now, the standard deduction is huge. For a married couple filing jointly, it's over $29,000. That means the first $29,000 you earn is basically tax-free. But when 2026 hits, that standard deduction gets cut almost in half. We're talking about it dropping to around $15,000 for that same married couple. You know what that means? An extra $14,000 of your income is now taxable. At even a 12% tax rate, that's an extra $1,680 in taxes for doing absolutely nothing different. Now, some people say, well, you can just itemize your deductions instead. Deduct your mortgage interest, your property taxes, all that. Sure, except there's a cap on how much state and local tax you can deduct. And for a lot of middle-class families, especially in states like California, New York, New Jersey, you hit that cap real quick. And here's the kicker. If you don't have a mortgage, or your mortgage is almost paid off, or you live in a state with low property taxes, you don't have enough deductions to itemize. So you're just stuck paying more. Let me give you an example. Sarah and Tom live in Ohio. They have 2 kids. They make $95,000 combined. They have a small mortgage, but not enough interest to make itemizing worth it. So they take the standard deduction. Right now, their taxable income after the standard deduction is about $66,000. But in 2026, when the standard deduction drops, their taxable income jumps to $80,000. Same job, same house, same life. But now they're paying tax on an extra $14,000. At their tax rate, that's over $1,500 more per year. That's a car payment. That's a family vacation. That's their emergency fund. Gone. You didn't earn more in real life, but the IRS treats you like you did. This is the line that hits, because it's true. Your paycheck didn't change. Your life didn't get more luxurious, but your tax bill did. Number 3, the child tax credit. And this one stings if you've got kids. Right now, the child tax credit is $2,000 per kid under 17. For a family with 2 kids, that's $4,000 off your tax bill, not off your taxable income, off the actual tax you owe. That's huge. But in 2026, that credit drops to $1,000 per kid. So that same family with 2 kids, they just lost $2,000, and it gets worse. Right now, $1,600 of that credit is refundable. That means if you don't owe much in taxes, you still get money back. But after 2025, the refundable portion drops to just $1,000 per kid. For working class families who rely on that refund to pay for back to school supplies, car repairs, or just to catch up on bills, that's a massive hit. Let me tell you about Maria. She's a single mom, works full-time as a nurse, makes about $52,000 a year. She has 2 kids, ages 8 and 11. Right now, that $4,000 child tax credit is basically her safety net. She uses it to cover summer camp, school supplies, sometimes a little breathing room in her budget. In 2026, that credit gets cut in half. She's losing $2,000, and because she's already living paycheck to paycheck, there's nowhere for her to cut back. She's not going on vacations. She's not buying designer clothes. She's just trying to raise her kids. But the tax code doesn't care. Her taxes just went up by $2,000. And here's what makes this even more frustrating. This doesn't affect wealthy families the same way. If you're making $300,000 a year, losing $2,000 stings. But it's not life-changing. But if you're Maria, that's a month of groceries. All right, number 4. And this one is especially brutal for dual-income households. The marriage penalty is coming back. Here's how this works. Right now, the tax brackets for married couples filing jointly are almost exactly double the brackets for single filers. That means 2 people who get married don't automatically get pushed into higher tax brackets just because they combine their incomes. But when the 2017 tax cuts expire, that goes away. The married brackets get squeezed. So if you and your spouse both work and earn similar incomes, you're about to get hit hard. Let me paint you a picture. Jake and Emily are both teachers. They each make $58,000 a year. Together, that's $116,000. Solid middle-class income, right? Right now, their combined income is taxed pretty fairly. But in 2026, because the marriage penalty comes back, a bigger chunk of their income gets pushed into a higher bracket than if they were just two single people. They're literally being taxed more for being married. It's like the tax code is saying, oh, you two decided to build a life together? Cool, that'll be an extra $1,200. And this doesn't just hit teachers. It hits nurses, accountants, engineers, IT workers, anyone in a dual income household where both people earn decent salaries. The kicker? If one spouse makes a ton of money and the other stays home, you don't get hit as hard by this. The marriage penalty mostly punishes couples where both people work full-time. So the tax code is literally penalizing two people for both contributing to the household income. You'd think the government would want to encourage people to work, but no, in 2026, the message is if you both work, you pay more. So let's talk about who actually gets hurt the most by all of this. Spoiler, it's not the rich. Wealthy people have options. They have accountants, they have tax strategies. They can shift income around, defer it, move it into investments that are taxed at lower rates. They've got ways to soften the blow. And people at the lower end of the income spectrum, they often get enough credits and deductions that they don't owe much federal income tax to begin with. But the middle, people making between $50,000 and $150,000 a year, you're the ones getting squeezed. You make too much to qualify for most tax credits. But you don't make enough to hire a fancy accountant to find loopholes. You just pay what the tax software tells you to pay. Salaried workers, dual income households, middle-class families. And you're the target here? Not because anyone sat down and said, let's screw over the middle class, but because the way these laws were written, you're the ones who lose the most when they expire. And here's the really frustrating part. This isn't an accident. When Congress passed the 2017 tax cuts, they knew these provisions would expire. They built in the expiration date. And now, as 2026 gets closer, there's no real plan to fix it. Because fixing it requires Congress to agree on something. And when was the last time that happened? So what do you do about this? First, don't panic. But don't ignore it either. Knowledge is power, and just knowing this is coming puts you ahead of most people. Here's the reality. You can't change the tax law, but you can prepare for it. If you're in a dual income household, start running the numbers now. Figure out what your taxes might look like in 2026. There are calculators online that can help. Or talk to a tax professional. If you've got kids, start thinking about how you're going to replace that lost child tax credit. Maybe that means adjusting your withholding so you're not counting on a big refund. Maybe it means building up a buffer in your savings. If you're close to retirement, this might affect when you decide to pull the trigger. If your income is going to be taxed more heavily in 2026, it might make sense to accelerate some of that income into 2025. Again, talk to a professional about your specific situation. And look, I know this video isn't exactly fun. Nobody likes talking about taxes. But this is real money we're talking about. For the average middle-class family, this could be $2,000, $3,000, maybe even $5,000 more in taxes. That's not pocket change. That's a big deal. Here's the thing. Most people won't see this coming. They'll file their taxes in April 2027 and go, wait, why is my refund so small? Or worse, why do I owe money this year? And by then, it's too late to do anything about it. But you're ahead of the game. You know what's coming. You've got time to prepare, so do me a favor. Share this video with someone who needs to hear it. Your parents, your siblings, your coworkers, because this affects way more people than realize it. And if you found this helpful, hit that like button. Subscribe if you haven't already. Because I'm going to keep making videos that break down the financial stuff nobody else is talking about. The stuff that actually matters to your wallet. 2026 is coming. The tax trap is already set. The question is, are you going to be ready for it? Or are you going to be one of the millions who gets caught off guard? I'll see you in the next one.